Hey everyone, welcome back to the channel, your number one source for income-oriented investing, how to generate passive income from a diversified portfolio of high-yield funds. It's a new year, we're in 2024, so I think it's time to do the top 10 lessons learned in 2023. So I did one for 2022 lessons learned as well. You could check that video out. A lot of great lessons in there. So I'll try to focus really on 2023 and the top 10 lessons I personally learned as an income investor. So hopefully you'll learn something from these points. So let's go through them all right now. And in case you didn't see the 2022 one, which has a lot of great valid points as well, I'll put the link in the video description below. So without further ado, top 10 lessons learned in 2023. What are they? Let's go through them. All right, everyone. Lesson number one. Streamlining and adjusting your portfolio can be a good thing. It's not something you should be afraid of to make your portfolio not only slimmer and streamline it, but more efficient. There's nothing to be afraid of. So I keep seeing comments of people saying that I'm no longer a passive investor because I sell things and I shift things around sometimes. That's not true at all. It's pretty ridiculous if you ask me. If you see some opportunities in your personal portfolio to make it better in any way, shape, or form, it makes you feel like you have a more efficient portfolio, whether it's for higher yield, whether it's because a new fund comes out and you switch to something you like better, that's okay. And it could be a very, very good thing in the future. So don't be afraid of doing that. Lesson number one. Lesson number two, I do prefer, of course, this is no brainer as an income investor, stable income, from covered call ETFs, which tend to always have very similar, distributions. Of course, there's some exceptions like QQQY and the Yield Max ones, but I'm focusing more on really the core stable ETFs like the Horizons ones and the Hamilton ones and things like that on the Canadian side. So I personally definitely prefer the ETFs and stable income versus, for example, missing dividends altogether like the split funds. Now, I'm not saying split funds are bad. It's just the way they are designed. All right. Either you get the distribution or you don't. Right. But with a covered call ETF, typically you'll always get a distribution. Can it vary? Yes, it'll vary. But I definitely prefer, varying distributions, whether it's up, of course, if it's up, or even down if they need to do a reduction versus just not getting it at all. Like it really sucked with DGS missing 6-7 months of distribution. That's $400 that I'm not getting every single month. I rather prefer a reduction instead of not getting anything at all. So just a lesson that I've learned personally, just a personal preference. And again, not saying there's anything wrong with holding split share funds. I'm just, explaining that my preference is really the funds that, are not structured like the split funds and typically always give out the dividend. Next lesson is that the US economy, the US stock market, the US market is king. This is more just a reinforcement. And I've been talking about this lately as well. I think the US overall stock market and indexes like the S&P 500, not only in the past, but also in the future will continue to outperform the overall Canadian stock market, the developed markets outside of the US, emerging markets. The US is king. It doesn't take a genius to figure it out, right? They have some of the best companies in the world. It's the most capitalist country. It's where businesses will always prosper more than a place like Canada where there's higher taxes. It's more socialist. So am I saying I'm just going to invest solely 100% in the US market? No, that's not what I'm saying. I'm just saying that, from 2023, you could really tell that I think the US economy, the US stock market is good. It's more diversified. The Canadian one, for example, is much more cyclical, right? Really strongly based on cyclical sectors like the financials and the energy. In the US, there's a lot of healthcare. There's a lot of technology, which is, technology is almost like a defensive sector now, like healthcare and utilities, because everyone needs technology, right? So I just feel that the US economy is king, and going forward, I will definitely have the majority, probably more than 80, maybe even more down the line, 80% allocated to US holdings. Next lesson learned is that having secondary opportunistic positions, things that are kind of sector specific, can be good, can be okay to capitalize when certain sectors are down, but they're not mandatory. So what do I mean by that? I'll give you a perfect example. I've invested in a ETF from Evolve called CALL, C-A-L-L, that only invests in US banks because I felt that at the time where US banks got killed. So when things go down, stock prices go down, the yield is much more attractive. It gets higher, right? So that's a perfect example of what I feel is a secondary position because it's sector specific. I wouldn't make something like that a primary position because it's not diversified, right? Like an S&P 500, it's only US banks, it's only the financials. But it's okay to do that. It's okay to have sector specific stuff. It's okay to invest in sector specific stuff where you feel there's a big opportunity, like real estate in 2023, like US banks, like energy, financial. Sorry about that. My little cat is here. Okay, just stay there. Just stay there. Yeah, okay. I love you too. Just stay there. So it could be a good thing, but what I mean that it's not mandatory is you could just stick with the diversified stuff if you want. You don't have to do and follow what I do. Yes. Can I help you? Is it true? Huh? All right. Come on. I'll come see you later. We'll play. Okay. Sorry about that, guys. So that's another lesson that I've learned. So something that you could do as well. Again, capitalize. Don't be afraid of, when it comes to call, I'll stick with the call example. I could very well sell it down the line when the US banks go up and then reinvest all of that in like an S&P 500, right? So you could do that as well. So just make sure, in my opinion, keep them secondary, but there's nothing wrong with investing in sector specific things. I'll be right back. All right, guys, lesson number 5. I'll do this. My cat's right here on my lap, so I apologize. Yeah, if you hear any noise. My wife's not here, so she's after me today. So lesson number 5 is I finally learned or went through what a classic cycle is. So 2020, 2021, 2022, I would say is actually scary because that's like COVID. That's Black Swan. But now what's going on now, guys, with inflation and raising interest rates and things like that, that's actually a normal cycle. So I finally went through it. I finally learned what a normal cycle looks like, which is a good thing. So this is actually like completely normal what happens in a normal environment, normal economic environment, right? You have inflation, they'll raise interest rates to cool down the economy, and then when they start cutting, it stimulates again. So it's finally back to normalcy. I'm finally happy about it. I feel nice and calm. And the next lesson is kind of tied into that. When interest rates go up and up and up, dividend stocks and REITs tend to suffer because what happens, this is something I learned actually by talking to Rob Lozon from Middlefield. We talked about this when we talked about Enbridge. What typically happens is people tend to, if GICs and bonds and fixed incomes giving like 5%, why would people invest in dividend stocks to get about that or even less? Because they could get the same thing or the same yield with less risk, right? So a lot of money goes out of dividend stocks or it stops flowing to dividend stocks and it goes into, those fixed income instruments. So again, just a normal thing, a normal cycle that I learned. And of course, the lesson is you got to capitalize on it. This is why I bought a lot of RS, a lot of REITs, and I even got, stacked on a little bit to GDV, things that focus really on dividend stocks, right? Next lesson, everyone, is that GICs, certificate of deposits or CDs, my opinion, still garbage. You don't need them. Please stop getting them. I know it's very tempting. You get 5%, 6%, whatever it is. It's not that high, but 5%. It's locked in. There's so many better alternatives. I have videos about these. There's great alternatives on both the US market and the Canadian market, more tax efficient, more yield, with more flexibility. You're not locked in, with a very high degree of safety as well. Don't give your money to the bank at 5%. They're just gonna lend it out and invest it and then pocket the difference, right, of what they made. So to me, it still doesn't make any sense. I strongly suggest you don't do it. Unless it's like really, really, really short term and you absolutely you're saving that money for a down payment. But there's so many great options out there. I strongly believe that even if you really, really are needing that money and you want that safety, there's better options. There's SPLT ETF from Brompton, which is a collection of all the preferred shares of the split funds. Very, very boring, safe stuff. You'll get a little over 6. You have the high ETF from Simplify on the US side, where you could get about 9% yield and the stock price barely moves. You could get a lot better than CDs and GICs. Next lesson is I'm really starting to love and prefer index-based, index style of investing over an actively managed stock picking style of fund, right? So for example, this was one small reason why I decided to swap my EIT.UN. That's a active strategy, stock picking strategy. I'm not saying it's bad, but I just prefer index investing. I think it makes the most sense for, long-term passive investors because you're guaranteed to have the best stocks all the time. Indexes change consistently. I'm just really starting to fall in love with this style of investing. Even as an income investor now, there's more index-based covered call ETFs, so it's getting easier and easier. A lot of these options ETFs didn't exist a few years ago. So I'm really liking index-based investing. I wouldn't be surprised if there's even more changes in my portfolio to go towards these styles of ETFs. Lesson number 9 is that I'm very comfortable, and I think it makes complete sense to have some leverage, to have leveraged covered call ETFs as a long-term yield investor. So if there would be an option between something identical, leverage and non-leverage, and what I mean leverage, it's a leverage fund that's modestly leveraged. 25% is the main number that the Canadian ETF providers typically use. Always 25%. Just Brompton has BMAX, which is at 33%. But it's typically 25. So it's very small leverage, guys. It's managed by the fund manager. They get the best rates. You don't have to deal with being margin called. It's all handled by them, and you get more yield, more exposure. So for someone who's buying something and holding it for long term, who has the intention of holding it long term, why not have that leverage, right? It makes complete sense. As long as you're doing on something that makes sense, that's quality assets, which my portfolio is pretty much all quality assets, right? Well, you could argue the Bitcoin and Ether, but whatever. Those two are actually not, or some of the only positions that are not leveraged in my portfolio. But anyway, I think adding that leverage makes 100% sense, and I'm very comfortable with it, because if you're adding leverage or borrowing money on something that's cash flowing, so if you're borrowing even if rates are high, right? Even now rates are at 5%, but if you're borrowing at 5% to invest in something that gives you a 10% yield, it makes sense, right? You have that buffer, right? But to borrow at 5 for something that's making 5.5 maybe doesn't make much sense. But for a high yield product, I think leverage is genius. It makes sense. I love it. And moreover on that point, I think I've really determined what my favorite style of covered call strategy ETF is. I think my favorite one has to be kind of what Horizons and Hamilton do. I love the strategy where they're yield first. So Hamilton typically, they're yield first. So they do at the money calls up to 50% or 30% of the portfolio. So the priority is the yield, but you're not giving up all the upside. I don't like funds, or I'm starting not to really like funds that do at the money calls or cover the whole portfolio, the whole thing with covered calls at the money. I think that a covered call fund should always have some upside, room to grow as well, but near that 50% mark is what I like, because you could get a lot of yield covering at 50% at the money or out of the money call. So a leveraged fund that does about 50% covered call coverage, which will give you that nice teen yield, I think is kind of my sweet spot for me personally. Maybe it's not yours, but that's okay. So I would say, Hamilton and Horizons come to mind. So I really loved that kind of ETF, that kind of covered call strategy. It's just typically my favorite, but it doesn't have to be yours. So that's lesson number 9. Lesson number 10, I think, is just, I'll do a quick mishmash of very important lessons I've already learned in the past, but reiterated in 2023. Number 1, you cannot trust single stocks and REITs when it comes to the income. They're always the most at risk at reducing the distribution, cutting it. This is why I got out of single stocks a long time ago. Look at this year, what happened with the True North and Innovalis REITs, right? You just can't trust them. Even if it's real estate, if it's REITs, you can't trust them. So I learned this lesson long ago in past year, but something very important that you could reiterate, or we saw again in 2023. Next one is split share funds can miss dividends. You need to understand closed-end funds and split share funds before you invest in them, and you have to expect that you could get missed distributions. If you're investing in something and the most important thing is the money, is the cash flow, because you're living off of it, it's very important. Well, then be mindful when you're investing in split funds that maybe they shouldn't belong in your portfolio because they can miss. It's a possibility, right? So that's obviously very important, and learned that as well a while ago. Last but not least, I want to keep a general premise here that the formula for success when it comes to investing, whether it's growth, whether it's income, It's always the same. It hasn't changed for 100 years. I don't think it's going to change for the next 100 years. You have to invest regularly in quality assets and think long term. If you just do those three things, you'll always be okay. Quality assets, keep investing over time. Don't try to time the market. Try to invest regularly as much as you can in quality assets and think long term. Don't worry about the week to week, month to month, year to year, recession, inflation, all this nonsense. And it's all designed to scare you. You gotta think long term. The stock market, remember, is 6 to 9 months forward thinking, maybe even 12 months ahead. So people who are, saving cash because there's going to be a big recession in 2024, an opportunity, that's not really going to plan, right? You've already missed some big rallies at the end of 2023. In my opinion, can never time the market. Doesn't make sense. The market typically goes up over the long term. So the best time to invest is always now. I just don't understand people who hold on to cash and wait and whatever. And of course, the power went out, but the generator is about to go back on. There we go. Sorry about that. So, geez, what a crazy day to film today with a cat and this stuff. So, yeah, guys. So that's pretty much it. I mean, hopefully these lessons were useful for you. What are your most important lessons that you learned in 2023, either as a newer investor, income investor, or a more experienced investor? Let me know. Are there any points you agree with more strongly that you learned as well, you disagree with? Let me know, and we'll do this again next year with hopefully a lot less interruptions. So see you next time, everyone. Take care. Hey, don't go yet. A few reminders before you leave. Did you know that I launched a YouTube loyalty membership program where for only $3 a month, you could become a PII Inner Circle member, where you will gain access to exclusive content, exclusive videos and live streams, as well as other perks and benefits, including a really cool weekly opportunity report. That's right. If you're interested, just click on the little join button next to the subscribe button to see what it's all about. Also, make sure to follow me on Blossom and download Blossom. It's a social investing app, which is really cool. You could share your portfolio, follow other people's portfolios, including my own. My username is Adrian_PII. So download it with the referral link below. Not only is it free, but you could actually earn cash by taking these really small, quick 1-minute courses. Really awesome. It's a no-brainer. Also, make sure to visit our website, passiveincomeinvesting.ca. That's where you could book a one-on-one private coaching session with yours truly, with myself, where you could ask me all the questions you want. All the information and booking information is on the website. Make sure to check out that video on the homepage there to see how to book a one-on-one properly. Also on my website, you could purchase my digital product, which I'm very proud of, the Ultimate DIY Investing Package. This is a reference tool or a companion tool that will help you build your own portfolio. So it has lists of funds, it has sample portfolios, and it covers both the Canadian and US stock markets. And the good news is you'll only ever have to buy it once, because it comes with free lifetime updates. And my plan is really to update the version every single year. So make sure to pick it up. Also, I have Questrade and Passive referral links below. So Questrade is the broker that I personally use, and Passive is the broker companion tool or assistant that I use. Really cool program, really cool software. So I have referral links for both of those. Questrade, $50 of free trades. And Passive, I have half off for the Elite membership. If you're interested in the Elite membership, and even if you want to start out with the free membership and upgrade to the Elite afterwards, use my referral code so you could still get that 50% off. And don't forget that the Elite membership of Passive is 100% free if you use Questrade. For social media, we have a very successful and big Facebook group, private Facebook group with over 14,000 members, where we all try to help each other out. So make sure to join that group. Information is below. We also have Instagram, where you could follow us, or more personal stuff when it comes to our life here in Panama. And there's LinkedIn as well. So as usual, everyone, how do I leave you? Continue to stay safe, stay healthy, and of course, stay passive. See you next time.